Another big week for markets. Tariffs certainly at the forefront of the investors' mindset at the moment, but things dialed down in terms of economic data with only a couple of major things happening this week. The big ticket item is going to be the US CPI inflation report. I'm going to take you through all of the different underlying metrics and why this is particularly important for markets, for the likes of the US dollar, the likes of gold, and the likes of the Dow. So let's get into it. First and foremost, this is the expectation of markets. According to Trading Economics, you can see we're expecting a core monthly figure of 0.3, a headline monthly figure of 0.2. That's notable, down from 0.4, and certainly we'll get into that. And then in terms of the year-on-year figures, 3.1 down in terms of the core figure and flat in terms of the year-on-year metrics. Now remember, headline inflation 0.4 last time around, seemingly very problematic because it's pretty much double where it needs to be, but an expectation that we come back to essentially where we need to be. We need to be around that 0.2 mark to get towards that 2% target. But of course, when you're racking up 0.4s, then you might have a problem. Now, in terms of one of the things that just happened recently last week, that what I first wanted to touch on was the ISM services prices paid metric. Of course, we saw this spike, and it's something that I was highlighting as a potential precursor to a resurgence in inflation. But we saw it come back in a meaningful manner. That pullback in terms of the prices paid elements of services PMI. Remember, services is by and large the bulk of inflation within the US. If we see a resurgence in services inflation, we're going to see a resurgence in inflation as a whole. Well, it pulled back pretty heavily, and that gives us a little bit of confidence that perhaps we're not on a trajectory that might see a major resurgence in terms of inflation. So it's eased some of those concerns. This is a breakdown in terms of headline versus core inflation. So firstly, on the top end, we've got the year-on-year metric. So you can see 3.25. So the economic calendar will show it's 3.2. The headline number at 2.9. Then we can see the month-on-month metrics in the middle. Now, what we can see most notably is that, firstly, the blue columns, which is the core figures, have been running above where we need it to be for the last 5 months, right? So you can see that line, which is just below that 0.2 mark, I believe it's 0.16 recurring. That's where we need to be on average to get to 2%, right? And core has been running above that for the last 5 months, I believe now. So that is problematic, and we need to see that coming down. There's an expectation we come in around about 0.3 in terms of the monthly metrics, and still above that level. So that's a bit concerning. In terms of the headline numbers, well, the trajectory has been up and up and up. If you look at the terms of those green bars from the middle of last year, they were negative in June. Then we moved up to around that 0.2 mark. Then we hit to 0.2 for August and September. Then we went up to around 0.3 in October, a bit higher once again in November, and then up to 0.4 in December. So this points towards a really worrying trend, that resurgence in terms of inflation really gathering momentum rather than cooling. And so the idea that we're going to see a 0.2 figure this time around bucks that trend, right? So this could be a really important announcement and report for that reason. If we look at the 8-month annualized, and bear in mind that the 8-month annualized essentially means where are we on track to hit once we see the first 4 months of 2024 taken out, because as you can see on the left-hand side of that middle section, there's some pretty solid numbers, and then it comes into May and June where they're very low numbers. So I'm saying, okay, once we see January, February, March, April, where are we going to be? Well, the annualized figures as it stands points towards core at 2.7, headline at 2.1, 2.2 kind of area. But bear in mind, that's pretty much the best it's going to get, because once we get to May and June, then we're having comparatives against negative numbers or low numbers. So then there's a good chance that inflation rises once again. So are we actually on course to even hit target? Well, for core inflation, no. And certainly, if we're looking at a 0.3 figure this time around, it sort of just reiterates the point that core inflation is not getting back down to target. But then you can caveat that by saying, well, The Federal Reserve cares about core PCE. So do they care so much about core CPI? They can say headline CPI and core PCE as their sort of two metrics to watch. So you would say the headline CPI is probably more important on this occasion. And the view is that we might get back to 2.15. And certainly if we get a 0.2 figure, which is what markets are looking for this time around, then that sort of helps us on that trajectory. It sort of cools things off after this period where we've been sort of running relatively high. This is it in terms of the 3-month annualized. So I've only changed the bottom section of this, and you can see last time around was 8 months. So where will we be once those next 4 months get taken out? And then, you know, over the last 3 months, what's that if it was sort of projected out as a year's worth? And you can see we've seen this major resurgence as highlighted by those green bars that they keep going up and up and up. The same thing has happened with that green line. 3.87 is the pace we're currently traveling on in terms of core CPI on the 3-month. In terms of the headline, you can see it's actually come down a bit, 3.3 though. So both of them are well above where they need to be. Obviously, we're in best shape in the mid part of last year, as you could see with those very low monthly metrics. And that helped drive down the 3-month annualized metric back towards that 2% target. And most notably, you can see that green line and the blue line both below that 2% point at a point. So at a time we were tracking below 2% at sort of 3-month pace, but we're no longer at that in that position. And certainly most worrying is that CPI head number that it just keeps climbing. So inflation and reflation is certainly an issue that hinders the ability for central banks to ease monetary policy. And that's why markets at the moment are pricing like 1 rate cut, right? Something like that, maybe 2 rate cuts this year at the most. Because inflation's coming back up and we have significant concerns about Donald Trump and what the imposition of tariffs might mean in terms of inflation of goods coming into this country. Certainly, you know, this is going to be really key. If we can see inflation start to cool a bit, then maybe we see a little bit more confidence coming into play. But if we see risk off coming into play, helping the US dollar at the same time that we're seeing resurgence in terms of US inflation, it all really builds a picture towards US dollar strength. This is part of the reason why we're likely to see the monthly figure coming down. Now, energy has been a key component that's been driving inflation recently in terms of headline CPI. And you can see that in terms of the month-on-month figure. We can see that 0.4 figure from last time, which is this green line. So it rallied up to 0.4 on the month-on-month US CPI. And that comes as we saw that sort of pop in terms of energy, but that pop essentially reversed when we saw Donald Trump take office, which was in January. Of course, this is the January report. And so you can see it's been moving sharply lower since then. So there's a good chance that it starts to roll over. You can see that correlation between these two here. And so do we start to see the month-on-month rollover? That's what markets are expecting. So this highlights why inflation and energy prices often go hand in hand, in particular headline CPI. And so the ability of Donald Trump to keep energy prices low is really key in keeping inflation low. If energy prices move towards the upside, if oil rises, then that drives headline inflation upwards. And that is problematic for the Federal Reserve and problematic for Donald Trump. This is a breakdown in terms of the sort of wider picture, a number of different ways of sort of chopping up the data. So what do we see here? This is the 12-month inflation rate change. And we can see on the top end, the most inflationary of the lot here is shelter. And shelter makes up 1/3 of inflation. So you can see that shelter is absolutely key in terms of driving down inflation. And what has it been doing? It has been on a steady downward trajectory. You can see the peak in terms of that sort of light blue line is much further to the right compared to the peak of these other lines. And it highlights how it's very slow to move. But you would think that that means that even if the others sort of base out and start to move higher, then this would hopefully continue to move downwards as it's very lagging in nature. And it would provide that downward trajectory and downward sort of pressure on inflation as a whole because of its very strong weighting within inflation and within core inflation. So shelter should be our friend, really, as we go forward and as that moderates. But it might take a bit of time because you can still see that it's well over 4%, currently at 4.6%. What else? We can see here core CPI largely flatlining, headline CPI sort of moving a bit higher of late, but really we've been seeing some sort of choppiness over the last year and a bit in terms of managing to try and get that back down to target. We can see in terms of upward pressure, we're seeing that core inflation excluding shelter moving upwards, and it really does highlight that the role of core of shelter in terms of driving down that core metric, because core hasn't necessarily risen to the same degree, but we are seeing core excluded shelter moving towards the upside of late. Now we can see that when, oh, sorry, I should chop that top left bit out. Essentially, this is looking at the same data, but with a 6-month annualized. So, of course, when you're looking at this one, which is the year-on-year numbers, doesn't necessarily tell you what's happening more recently. So that's why I like to utilize the annualized figures, whether it's a 3-month annualized, which is saying what's the last 3 months done, or the 6-month annualized to say, okay, over the last 6 months, if that played out over the course of a year, how are we doing? So that's somewhere in the midpoint. It's not super reactive to near-term data. It gives you a good idea of sort of something a little bit more relevant than the 12-month. And so what have we been seeing here? Well, we're seeing continued, there we go. We're seeing downside in terms of that shelter component. So that's good. We're seeing upside in terms of the likes of the CPI number. So we've seen that in terms of previous charts, so that's a resurgence in terms of those month-on-month figures for CPI. And in terms of the green line, the core excluded shelter also rising more steeply on this chart than the last. We can see also, that we're seeing downward sort of trajectories for many of the other parts within this chart. And so, not all is lost. Services in particular is particularly important. Remember, we were talking about ISM services, prices paid element, and it spiked, but it's come back now. Well, services excluding shelter at 2.1%. And services has been one of the big inflationary problems. And so shelter is within services, right? So what do we need to see? We need to see services coming down without shelter, safe in the knowledge that shelter should continue to come down. It's very lagging. It's likely to continue to drift lower, even though it is very elevated still. So if services excluding shelter is coming down, if shelter is coming down, then that's all a good news story. But of course, we still have fears around what might happen under Donald Trump with the tariffs and with goods inflation coming into play. But certainly that is at least a good news story within it. In terms of market expectations, you can see here right now markets coming for the 10th of December meeting. So where do we stand by the end of the year? 36% chance that we've only seen a single rate cut this year. 19% chance we don't see a single rate cut. And then the rest of it's attributed to 50 basis point cut, so 29%, 12% chance of a 75 basis point cut. So right now, markets are very skeptical about the idea that we're going to see many rate cuts at all this year. That should be good for the US dollar. And that's something that we'll get into. So this is the Euro 2-year swap versus the US 2-year swap, and at the bottom the differential overlaid with euro dollar. So what we can see here is that the differential and the differing sort of trajectories of the 2-year swap for the euro versus the US is essentially driving the currency pair, right? You can see very close correlation. So what does that mean? Well, inflation expectations are essentially wrapped up within that 2-year swap. Where are we going to be in 2 years' time? And certainly the outlook for US inflation, therefore, plays a key role in terms of driving the likes of euro dollar, driving the likes of the US dollar, of course. If we think that we're going to see higher inflation, if we think we're going to see more protracted inflation, and that's going to keep interest rates elevated, we're likely to see a stronger dollar. At the same time, those inflation expectations are driven by what's happening within the markets. So, of course, if you see Donald Trump enacting major tariffs and saying that he's going to have retaliatory tariffs on any country that imposes it on the US, then all of that really feeds into that same narrative, which is inflation. And we don't necessarily know if it will be inflationary. We don't know if he's suddenly going to come to an agreement which would sort of eradicate what he has already imposed. And we saw that previously with Mexico and Canada. They had the 1 month delay. So that kind of thing is bad for the dollar. But when we see tariffs being imposed, because we don't necessarily know exactly what that's going to do in terms of inflation, that provides dollar strength. And at the same time, if we're seeing inflation reports like the one that we're seeing on Wednesday, That, of course, drives inflation expectations. If it comes in hotter than expected, expect US dollar strength. If it comes in weaker than expected and we see nice signs in terms of the underlyings that inflation's coming off in a meaningful manner, then that should be weak for the US dollar. So let's first and foremost jump into the dollar index. So this is the dollar index on let's go to the weekly time frame. So we can see here we sort of consolidated for an extended period of time and then rallied onwards from here. We've pulled back of late. And so we've seen a fair amount of chop, in no small part due to the fact that we're seeing a lot of uncertainty around these tariffs. You know, if there's a big story about them being imposed, then suddenly people see US dollar strength. If we see a potential agreement and a breakthrough, then suddenly we start to see the US dollar coming off. If we were to see, on this occasion, inflation coming down in a meaningful manner and it coming in weaker than expected, driven by those energy prices weakness, then that could provide some downside in terms of the US dollar. Now, something I've highlighted in the past is that when we saw Donald Trump come into power previously, I should have put it onto these slides, but we essentially saw a run-up post election. We saw the inauguration, we saw a spike post that, and then we rolled over and we saw about a year's worth of downside for the US dollar. Now, we're still within that period where markets are very fearful of tariffs, what that might do in terms of inflation. And so we either need to see the tariffs announced and then cancelled, or we need to see the tariffs announced and markets are quite chilled about it, all of a sudden not necessarily too fearful. And that arguably is what we have started to see here, because the reaction on the Monday certainly doesn't necessarily mimic the reaction to his previous announcements on Mexico and Canada. So we're seeing markets sort of reacting to a lesser extent, which is notable and might sort of pave the way for, when there is an agreement, that paves the way for potential weakness in terms of the US dollar. But yeah, I think there is certainly a blueprint that is likely to be followed that leads to the US dollar weakening. But of course, we need to get through this first hurdle, which includes, you know, how severe are these tariffs going to be and what impact will they have on inflation? And then, of course, now is different to 2016, 2017 in terms of the inflation outlook and in terms of where interest rates are. And so will US inflation surge under Donald Trump, irrespective of what's happening in terms of tariffs, you know, in terms of consumer spending, in terms of what the businesses are doing in reaction to his policies, or will it not? And if it doesn't, and it starts to come off in a meaningful manner, then you like to see US dollar weakness. But certainly we're in this sort of wait and see mode at the moment, as we're trying to weigh up the possibility that a Donald Trump presidency is good for markets and he manages to keep a lid on inflation, because he knows that that's key within managing to do everything that he needs to do. Bear in mind, he's trying to drive down debt, and key to it is the borrowing costs are sky high because interest rates are high, the 10-year is high, and so he needs to drive down inflation. He knows that that's going to be one of his key things. So will he be able to do that? So we're in a wait and see mode at the moment. I foresee a potential protracted period of weakness for the US dollar, but at the moment there's a lot of uncertainty. And if we see this inflation report coming out strong, then there's a good chance that we sort of build on the gains that we have started to see here, and we continue this sort of higher, low intraday move. But certainly for the time being, we're in this sort of wait and see mode. But I do think that once we settle down and we see greater clarity, there's a good chance that we do see the US dollar strengthening. In terms of the Dow Jones Industrial Average, it has managed to recover a significant amount of the weakness that we saw at the back end of last year, and we've rallied back up towards these record highs. You can see around there 45073, we sort of pulled back, so we're in a bit of a chop mode at the moment. You can see flatlining lows around about your sort of 43800 mark, and then at the moment, you know, have we sort of retraced here and started to move higher once again? Well, we've come into that deep fib retracement zone and we're starting to see the bulls coming back into play. Certainly if we break the 43800 mark, essentially, then we've got this topping pattern, and it points towards a wider retracement of this rally that we saw at the beginning of this year. But until that happens, you know, there's a sort of tightening mood coming into here as we remain below this horizontal resistance level. And certainly any breakthrough that comes throughout in terms of weaker inflation data on Wednesday, in terms of breakthroughs on tariffs that see us sort of eradicate the idea that we're going to see major breakdown in terms of trade relations. Those are the kind of things that should be bullish for the likes of the Dow Jones going forward. And finally, I wanted to touch on gold. Gold is certainly one of our clients' sort of favorites, and for good reason. It's been outperforming heavily of late, and you can see here in terms of the gold price at the top end here climbing. Now, I've done these vertical lines on that chart, and that highlights the inception of the easing periods for the Federal Reserve. Bear in mind, people often say that that gold is a haven, and therefore when markets are crashing, get into gold. I don't say that. When markets are crashing, gold's going to go down because people just liquidate their positions across the board, and we've seen it time and time again. However, when we see central banks with QE announcing or enacting QE or cutting interest rates, that is when we generally see gold doing well. And that's exactly what we're doing at the moment. Notably, I've overlaid the two-year swap here. So what we should see here is that there should be an inverse correlation here, which means that the higher that those inflation expectations rise, so the two-year swap, we should see that sort of hindering the price of gold. Because it cools the amount of rate cuts that are expected from the Federal Reserve. That hasn't happened this time, and that's particularly notable. We've seen the two-year remaining elevated, and we're seeing gold moving higher at the same time. That, to me, points towards the idea that there's other things in play here, and in my mind, a lot of it is driven by huge buying pressure from many of the BRICS nations. We've heard just recently that China is essentially trialing something that allows insurance firms to buy gold and hold it on their books. And so I think that there's this huge amount of buying pressure coming from overseas nations, the likes of the BRICS nations in particular, that is propping up prices rather than simply a sort of retail market reaction to what's happening in terms of inflation, which means if we do see inflation coming down and we see rate cuts gathering momentum, that just provides another tailwind to the gold strength story. But at the moment, it's moving upwards despite the fact that the two-year isn't necessarily coming down, which is what you would sort of think would be the major fuel for gold to move higher. So if we're looking at the chart, I mean, quite frankly, we're looking at a chart that continues to go up and up and up, right? So we can see here on the hourly time frame, that's exactly what we've seen. We've kicked off the week with another record high. Let's go on to the weekly time frame. So we can see long term, this is a market that performs well. We do have protracted periods of downside and consolidation, but the long term trend is up, and we're within another one of those phases, right? So the daily time frame highlights that retracements are relatively few and far between. So it's a sort of pullback rally. This is the intraday moves. Then we've seen this latest consolidation and retracement, pullback rally into record highs. So we're now up onto the next leg higher here for gold. So key to that is if we do see weak inflation data coming out, that should be good for gold. If we see heavy sort of high inflation data, that should hinder gold. But at the moment, you're sort of betting against a market that is on such a strong run at the moment that, you know, they tell you not to catch a falling knife. Well, you shouldn't necessarily catch a rising knife either, to be fair. So you're talking about a market that is clearly within a very clear uptrend. So 28.34 is the key level towards the downside. If we break that level, then it looks like we could see a more protracted move lower. But until then, higher highs, higher lows, they continue to play out within a bullish theme as we head into an inflation report that, if we see it coming down in terms of US CPI and hopefully the energy price decline should help that, then that should also provide a tailwind for gold prices that have been on a massive ramp upwards of late. I hope that's been useful. Make sure to like, subscribe, and follow for more content at Scope Markets. My name's Josh Mahony, Chief Market Analyst. Have a great day.